Well, good morning. I'm Jagender Rana. The topic of the day is insurance reforms in India. Insurance reforms in India. India's insurance industry, long seen as an underpenetrated yet promising market, is poised for a major transformation with the government's proposal to permit 100% foreign direct investment and insurance companies and introduce composite licenses. These reforms, if implemented effectively, could catalyze significant changes in the sector, attracting fresh capital, improving competition, and enhancing accessibility for customers. So the proposal to allow 100% FDI in the insurance sector marks a pivotal moment in the liberalization of India's financial services. Historically, foreign insurers were mandated to have Indian partners with the maximum permissible foreign ownership capped at 74%. This structure, while aimed at safeguarding domestic interests, often deterred global insurance players from fully committing to the Indian market. So the proposed removal of the 74% cap will not only encourage global insurers to enter the market but also provide existing foreign investors the flexibility to expand their stakes or operations. One of the most anticipated outcomes of this move is the infusion of much needed capital into the sector. So insurance companies require significant investments to build robust operations, develop innovative products, and scale their reach to understand areas or to underserved areas. So the Reserve Bank of India's reluctance to expose balance sheet of banks to non-core businesses, such as insurance, coupled with a low private investment climate, had starved the sector of much needed capital to drive penetrations. So with foreign insurers now able to establish wholly owned subsidiaries, the sector is likely to see enhanced financial strength, paving the way for the product innovation and technological advancements. The success of this reform hinges on the regulatory framework, within which foreign investors will be permitted to hike their shareholding. For instance, foreign investors have the option of acquiring up to 74% or 100% and nothing in between in private banks. So regulations must eschew such an approach and leave it to investors to determine their level of shareholdings and focus on ensuring that Indian operations are sufficiently ring-fenced from global operations of the insurers. So imposing overly restrictive conditions could dilute the attractiveness of the reform, and a transparent and investor-friendly approach could solidify India's position as a lucrative destination for global insurers. Another significant proposal is the introduction of composite licenses, which would allow insurers to operate across both life and non-life business lines. So currently, companies are required to hold separate licenses for these categories, leading to operational slows and inefficiencies. The ability to offer a broad spectrum of products under a single license is expected to streamline operations, reduce redundancy, and improve customer experience. The composite license will also enable insurers to present a comprehensive suite of offerings to customers without approaching them repeatedly for similar data points. This will not only enhance efficiency but also build a stronger, more cohesive relationship with policyholders. So the integration of life and non-life insurance products under a unified framework can encourage cross-selling opportunities, making insurance offerings more attractive and tailored to customer needs. However, this transition is not without its share of challenges. Many insurers in India operate through joint ventures with foreign partners, often splitting life and non-life operations between different entities. So, aligning these arrangements under a composite license model could require renegotiations and strategic realignments, which may be complex and time consuming. Nonetheless, these hurdles should not deter the implementation of a concept whose benefits far outweigh the challenges. So the government and the Insurance Regulatory and Development Authority of India will provide detailed operational guidelines on critical areas such as capital requirements, product structuring, and regulatory compliances under the composite license framework. Regulations must avoid an approach that will result in insurers being forced to create operational and product laws for different lines of businesses and must instead afford insurers maximum flexibility on such matters. The clarity on these aspects will be instrumental for incumbents and new players to adopt a new regime. India's insurance penetration remains below the global average, underscoring the need for bold reform to make insurance more accessible and affordable. The proposed changes permitting 100% FDI and introducing composite licenses are steps in the right direction. These aims to not only attract foreign capital but also foster greater competition within the sector. Innovations in product offerings, improved services, standards, and competitive pricing arising from greater competition will ultimately benefit customers. These in turn could make insurance a more appealing option for a larger segment of the population, contributing to higher penetration rates. So additionally, the infusion of capital and expertise from global players can bolster the industry's capacity to adopt advanced technologies such as artificial intelligence and data analytics for risk assessment, claims management, and customer engagement. So India is moving closer to allowing wholly owned foreign insurers to operate in the country. This caps a decade of liberalization of the insurance sector, during which FDI limits were progressively relaxed to stand at 75% now or 74% now. So reluctantly it has been realized that local capital is holding back the spread of insurance in the country. The industry works best with patient capital with gestation beyond the comfort of Indian partners in foreign insurance ventures. As the sector is drawing in more FDI, it is not of magnitude to deliver on the promise of insurance for all by 2047. India's current insurance penetration, the ratio of insurance premiums to GDP is around a third less than the global average. So in terms of premiums paid per capita or insurance intensity, the Indian number is almost a tenth of the global average. Capital is not the only factor holding back growth of insurance here. Regulatory structure for the industry also needs reforms to put customers in focus. Lengthy and reluctant claim settlement does not inspire trust among customers. Neither does mis-selling of insurance products. For choosing quick profitability, insurance companies have not been able to build adequate customer confidence for market expansion. Rules should nudge them towards a business model built around trusting customer claims. Wider regulatory reform is also in order to curb insurance frauds. So spreading coverage is the only sustainable approach to keeping insurance costs low. Fresh capital infusion with realistic expectations of return will contribute. Our goal must give greater the growth GOI, Government of India, must give greater attention to the non-financial constraints on the insurance industry. The sector's regulator cannot, on its own, bridge the trust deficit between insurers and insured. It will require an all-of government effort to push insurance in the country. The deadline for universal coverage is not too distant, considering how little progress the industry has made since it was privatized at the turn of the century. So this 100% FDI in insurance may attract global firms, boost competition. It has been nearly a quarter of a century since the Indian insurance sector was liberalized. So despite the presence of 27 life insurers and 34 non-life insurers, one domestic reinsurer and 10 foreign reinsurance branches, the need for a greater number of players, particularly specialized ones, has never been more pressing, given the significant coverage gaps that continue to challenge the country. Even as on date in India, only 27 life insurers are there, 34 non-life insurers are there, one domestic reinsurer is there, and 10 foreign reinsurance branches. In the last few years, 6 new players have entered the insurance industry, marking the first additions in the life segment in over a decade and the first in the general and health insurance segments in nearly 5 years. The number of insurance companies in the country is not enough to cater to the evolving need of 1.4 billion people. There is a need to bring more and more capital into the sector from domestic and foreign resources. So we have removed all the entry barriers for floating an insurance company. Today, every class of investors or funds, private, equity, venture, capitalists, institutional investors, family offices can invest in the insurance sector and become an investor or promoter. So, according to the annual report of IRDAI, the penetration of the life insurance sector in India reduced from 3.2% in 2021-22 to 3% in 22-23, while that of non-life insurance sector remained at 1% in both these years. So India's overall insurance penetration reduced to 4% in 2023 from 4.2% in 21-22. While penetration has gone down in 20-23, the life insurance density increased to $70 from $69 in 21-22. Non-life insurance density remained stable. In 22-23, the insurance density in India increased from $91 in 21-22 to $92 in 2023. So global insurance penetration and density were 2.8% and $354 for the life segment, and 4% and $499 for the non-life segment. So overall insurance penetration and density were 6.8% and $853 respectively in 2022. Insurance penetration is measured as the percentage of insurance premiums, and the insurance density is calculated in gross domestic product as the ratio of premium to population per capita premium. So India needs at least double the number of insurance companies. The United States, with a population of around 340 million, has about 700 life insurance companies, which now translates to roughly 5 lakh policyholders per company. Similarly, the United Kingdom, with a population of 70 million only, has 325 life insurance companies, averaging around 250,000 policyholders per company. So if the same analysis is applied to the number of cars, property assets or other population related data, a similar gap is seen. Reaching 1,000 companies is challenging, which is why the number of insurance companies should be doubled. The IRDI has urged conglomerates, private equity ventures, capital fund, family offices, and others to invest in the insurance sector in India. The other way to bring more investments into the sector is to open up the sector to 100% foreign direct investments. So when we are talking about insurance for all by 2047, obviously we need a lot of capital, which means we need a lot of new entities to come in. Some consolidation may also happen if the FDI route is also opened. That will just augment the domestic investments, otherwise the domestic investment may get crowded. Perhaps it is the time to open up the insurance sector for 100% FDI, so that there could be more players who want to come to the India to operate on their own terms without trying to look for an Indian partners. If somebody comes at 74 is equal to 26, that is also fine. But opening up the sector for 100% FDI will attract more investments to come into the country. In December for 2014, the government raised the FDI limit in the sector from 26 to 49%. Nearly 7 years later, the government further increased the limit allowing FDI investments up to 74%. So the jury is divided on whether this move has led to the expected inflow of investments. Without full autonomy over business operations, something a foreign insurer would ideally need when setting up shops in a new country. And given the challenges of finding an Indian partner who aligns with the company's culture and ethos, attracting inflows into the sector has become difficult. So following the increase in the FDI limit, only a handful of companies, the foreign partners, have increased stake. AGA's Insurance International has hiked its stake to 74% in AGA's Federal Insurance following IDBI Bank's exit from the insurance venture. Similarly, in Aviva Life Insurance, the foreign insurer stake has gone up to 74%. In Future Generali Life, Italian insurer Generali has upped its stake to over 72%. Meanwhile, Swiss insurer Zurich Insurance acquired a 70% stake in Kotak Mahindra General Insurance for $670 million from Kotak Mahindra Bank. So recently, Munich headquartered Allianz SE, one of the largest insurers in the world, indicated that it could be exiting its India joint venture with Bajaj Group, in which it holds 26% stake each in the life and general insurance companies since inception in 2001. However, it has also indicated that it remains committed to the Indian insurance market but will not speculate on alternatives. So 100% FDI is something most large players are asking for. We should keep norms in place to secure the investment to India and a steady flow for multi-year, including strict exit clauses, business cases that allow for increasing the pie as opposed to eating into the pie, and a proven track record but allowing 100% stake will certainly help with the inflow of money. New transformations, global capabilities in India, more competition leading to better efficiencies. Many markets and large brands across Europe and Japan are very interested in penetrating the Indian market, and a 100% FDI will certainly help, rather than trying to find joint ventures with similar wavelength of thought process. So when the global insurers look at expansion, they always keep India as their priority, and then they want to build something in India on their own. So it is not about just adding more number of players to their segment. It is about adding people who are more specialized in or more focused on different segments or different lines of business. Thank you very much.